Welcome to the Essential Tax Podcast with your host, Mishkin Santa. In each episode, we'll take the complex world of tax, all the jargon, acronyms, and stuff that make your eyes glaze over, and explain it in an impactful way to understand the complex and unknown areas. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcasts, Spotify, and on our website, thewolfgroup.com. Now, here's the host of Essential Tax Podcast, Mishkin Santa.
Hi, everyone. Welcome to the Essential Tax Podcast. It's Mishkin Santa here, your host. Andrea Solana, welcome. How are you today?
Thank you. Thanks for having me, Mishkin. I'm doing well, thank you.
Great.
With you.
Well, we have Andrea on the show today. She's going to talk to us about some of the things that are happening in the United Kingdom with some changes that they have going on, which is very, very exciting. I'm sitting here with my bowl of popcorn as I'm watching all the stuff go down in the UK. I have a lot of clients, US clients, that are living in the United Kingdom or thinking about going to the United Kingdom. And so this is a super interesting topic for me as a practitioner. But in general, I think anyone that has cross-border ties between the US and UK, this is going to be an interesting podcast for you. Before we get into all the nuts and bolts and all the moving parts, Andrew, why don't you tell the folks that are listening a little bit about yourself, your background, kind of fill in some details about who you are.
Yeah, sure. So my name's Andrea Solana. I'm a partner and head of advanced planning at MASECO Private Wealth. I've been with the firm for 11 years now, which is hard to believe, actually. But I essentially head up the wealth planning part of our service offering, and MASECO Private Wealth focuses on providing wealth management advice to US connected people, mainly here in the UK. And we are very involved in that regard in cross-border advice touching the UK and the US. We manage about 3.4 billion in assets under management and work with about 1,300 households. And yeah, we're very entrenched in these potential changes that are happening over the next year.
Yeah, I mean, I get a lot of clients that I work with move outbound into the UK for a variety of reasons. Maybe they're taking a job, or they're from the UK originally but have been in the US for a while and they're moving back. They're retiring to the country, and a lot of times when they ask me about who can I talk to for wealth and financial management, first person that always comes to the top of my head is Andrea. So we've been working together for quite some time. Okay, let's get into the nuts and bolts of what just happened in the UK. So on July 4th, I was in my wife's hometown watching the parade go by, but I kept on checking my phone. Not that I thought anything drastic would happen with the UK elections, but it was just kind of monitoring what was happening out there. Can you give some background about maybe some things that occurred prior to the general election that happened in the United Kingdom, and then talk about that election and kind of what that means over there?
Yeah. So, I guess coming into 2024, we knew that there was going to be a general election in the UK at some point during this calendar year, but it was unknown in terms of exactly when that would happen, because there is kind of more flexibility in terms of when the government calls an election than, say, there is in the US. And coming into 2024, it was a scenario where there was a Tory government that had been in place for the last 14 years. And there was more and more kind of consensus or feeling across the board that when the general election came, that it was likely that there was going to be a change in the party that is in power. And so there already had been a lot of kind of speculation around what changes may take place with any party change from a government perspective. And interestingly, what ended up happening earlier this year was back in March, there was the normal spring budget statement that then Chancellor Jeremy Hunt basically, announced to the government that essentially part of the changes that they were going to propose was actually a big change to the non-domiciled tax regime, which has been in place in the UK for hundreds of years. And that came as a bit of a surprise, that it was the Tory government that was basically putting forth this proposal. But I think it was in anticipation of the fact that they generally knew that they probably weren't going to win the election later in the year. And they wanted to kind of steal Labour's thunder a little bit in terms of getting out ahead of proposals that they knew the Labour government was going to want to, actually be enacting themselves. And so we had, basically these proposals announced back in March, which then started the ball rolling with respect to what changes we may see. And consultations began in the background with stakeholders that would be impacted. And I think the hope was that there was going to be some draft legislation ahead of any general election that was eventually called. But what ended up happening was that the general election was called in early June. And 4 weeks later, essentially on the 4th of July, there was that general election. And to nobody's surprise, Labour ended up coming out with a big majority, at the end of the day. And so now we're moving forward with that new Labour government. And they are having the opportunity to put their stamp on any changes that do actually take place.
Okay, so talking to me like I'm a 3-year-old here. The Tory, I know that the political system or the political parties in the UK are not exactly the same as the US, but the Tories would be equivalent to what political party? Labour, what political party?
Yeah, if you kind of boiled it down to a similar two-party system from a US perspective, then the Tories would be the equivalent of the Conservative Party, the Republican Party, and the Labour Party would be the Democrats.
Okay, and then also continuing to talk to me like I'm a 3-year-old. This non-dom regime, what is that? What does that mean? I think people in the United States, we may have heard of the word domicile. That's where dom comes from. It's not something that we really talk about from our tax perspective. We talk about residency. And then you guys have the concept of residency as well too. But can you kind of just, 50,000 foot view explain not the non-dom rules and what those mean?
Yeah, sure. So essentially, a non-domiciled individual ends up being an individual who kind of wasn't born in the UK and also wasn't born to, for instance, a father who was born in the UK and lived in the UK. So, if you had that scenario where your father was a UK person and you were also born in the UK, then you're automatically known under UK domestic law as something as having the domicile of origin. But then non-doms are people that basically don't meet that definition. And if they come to the UK, there was a whole kind of subset to the tax system where non-domiciled individuals enjoyed special privileges per se around how they were taxed in the UK. And in the most recent form, because there have been changes to that tax regime over the years, but in its most recent current form, essentially non-domiciled individuals only have to pay tax in the UK for the first 7 tax years based on income actually earned in the UK. And any untaxed income that they actually bring onshore and use in the UK at the time that they actually bring it onshore. And then after, for instance, the first 7 tax years, a non-domiciled individual can either move on to what's called the arising basis, where they would pay tax in the UK on their worldwide income, similar to, say how US citizens are taxed in the US. Or if they continue to want to be taxed on this kind of remittance-based tax way of being taxed, then they could pay an annual charge in order to continue to access that type of tax system. And they would be able to do that up until they met a residency test of being in the UK for more than 15 out of 20 years. And once a non-domiciled individual was resident in the UK for more than 15 out of the last 20 years, then they would become what's called deemed domicile for both income tax and inheritance tax purposes. And so after that point in time, they would automatically have to pay tax on a worldwide basis in the UK. And then equally, their worldwide assets would be viewed from an inheritance tax lens in the UK as well. Importantly, I guess, prior to becoming deemed domicile, non-domiciled individuals from an inheritance tax perspective would only have exposure to UK inheritance tax with respect to UK situs assets, so generally, assets onshore in the UK, and they would not be exposed to UK inheritance tax on assets, for instance, held in the US or other parts of the world.
Yeah. Okay. Yeah. That's very interesting. And so, in the U.S., we kind of joke that additional charge that you pay to get to the 15 years is a ransom. It's the annual ransom fee you have to pay to continue in the non-dom regime. What you described, though, prior to that, I believe, is called the remittance basis, meaning that you actually have to remit income or assets into the UK. Can you just briefly talk about that? Because I believe that's a pretty big concept for what is going to be changed under the proposals.
Yeah, correct. So essentially, if you move to the UK and you maintain assets outside of the UK, if those assets outside of the UK earn interest and dividends and capital gains, you would not have to pay tax on that in the UK unless you actually physically remit that money into the UK. So if you had a bank account, to keep things simple, that consisted of cash and some interest income that had been earned in that account, and you later want to bring in, say, $50,000 worth of money into the UK to utilize for spending purposes in the UK, or maybe you want to kind of purchase a house and bring assets from offshore into the UK. The act of transferring those assets into the UK is a deemed remittance, and any untaxed income that was made up inside of the amount that you have brought onshore, you would pay tax in the UK on that at that point in time.
Okay, got it. Okay, so we've gone through the alternative tax regime for the people that qualify. You have to go through all those qualifications, make sure you meet the qualifications for the non-dom regime. You get into that. There's this concept of remittance. You have, inheritance tax that you really don't have to worry about unless you become deemed domicile or you switch over to the traditional taxation system in the United Kingdom. Okay, let's now shift gears, since we now know all that. That's our baseline. Let's shift gears to what's the proposals? What are they saying? What's kind of floating around out there? And how does it affect those different parts of what we used to know as the long-standing tax regime in the UK?
Yeah. And I guess, one thing I'll kind of say up front is we have kind of the proposals which were originally announced by the Tory government back in March. And then since that point, we have, off the back of the election, in recent days, Labour has has basically issued a policy paper which reiterates what points of the proposals they intend to take forward, and what additional changes they may or are looking to actually enact within these changes. But one thing to note is that right now we still don't have any sort of draft legislation or some specifics around some of the changes. And so there is both a little bit of, we know intended direction of travel, but there is or there remains some areas that we await detail on in terms of exactly how it's going to take shape. But from a broad standpoint, basically, the move for the non-dom regime is essentially to eliminate the non-dom regime as we know it altogether and actually move to what the government is calling kind of a more modern and simpler residency-based tax system. So kind of the concept of domicile in the way that somebody is taxed is no longer going to be a basis for tax going forward. It will be purely based on meeting certain residency requirements for, say, somebody new to be moving to the UK as to how they will be exposed to income tax, capital gains tax, and inheritance tax.
And for residency, you mean like a day counting? So in the US, we have our wacky substantial presence test, which looks over the 3-year period, and you kind of do the hokey pokey. And if it goes over 183, then you're a tax resident. Most countries, I think it's just a straight up 183-day test. Is that something similar to what would happen in the UK, or do we not have any inkling of where that's?
It's so we do have visibility that kind of the way residency is going to be determined will not change from kind of the existing system of determining actual tax residency. And right now, basically, the way that works is there's something called the statutory residence test, or SRT, which essentially looks at a series of ties that somebody has to the UK. And alongside that, depending on the number of ties somebody has, there is a day count that then basically will correspond with making somebody UK tax resident. So for instance, generally, somebody could easily spend 90 days or less in the UK without having any sort of kind of issues from a residency standpoint, unless they have large amounts of ties. But thereafter, when you're looking at falling between, say, 90 days and 183 days, it is then based on the types of ties that you have. And the types of things that they look at is, for instance, UK accommodation available. Do you have family members in the country? How many days are you working in the country? Those sorts of things.
Okay, so still a little bit more subjective. I think we should also alert the audience that the UK, and maybe you were going to talk about this, so maybe I'm jumping ahead, but you operate on a different type of tax year than the US. The US operates off of a calendar year, whereas the UK operates off of a fiscal year. Do you want to just briefly describe that for the folks?
Yeah, that's correct. So basically, the UK operates on a 6th of April to 5th of April financial year or fiscal year, compared to the calendar year basis from a US perspective.
And I think when we talked prior to this, you hammered home to me like April 6, 2025 is a key date, which I'm sure you'll get to a little bit later, but I just want to make sure to keep that in everyone's head as we move forward. Please proceed.
Yeah, I mean, well, so just to touch on that, I mean, the 6th of April 2025 is basically when these proposed changes are supposed to take effect. So the new regime will be in place from the 6th of April 2025 onwards.
Okay, so you basically would have from now until, if I'm understanding correctly, your planning window is from now until April 6, 2025. And so if you don't have your ducks in a row, And some of my clients, they don't even know where their ducks are at. So getting them in a row is a little difficult, but you got to do it, and make sure you get your stuff straight by April 6th, 2025. And so when we talk about the various people that this could affect, I originally came up with three different kind of groups or buckets of people. Andrea, you said, well, we should also think about people that are already deemed domicile. But so we have those folks. They've come inbound into the UK. Maybe they've been on the non-dom regime for 7 years, 8 years, 15 years, whatever it is. Now they're deemed domicile. You have people that are in the midst of the non-dom regime. Maybe they've just started out. They're in year 2, year 3, year 4. So they're in the middle of it. We have people that maybe just started this last UK fiscal year, right? They just got there. They're like, oh, goodness, now I'm here at the forefront of the changes that are happening. And then you've got people that are considering moving there in the future. And I layer some context around that because Portugal's closed up their golden visa. Spain seems to be tightening up a little bit too, because those are the two really hot spots that I think a lot of US people were really looking at. You've got Malta kind of throwing their hat in the ring. Italy's kind of revitalized their 10-year program or 15-year program, whatever that is, the 100,000 flat euro a year that they're trying to push to everybody. So there's different people that are competing for having people come inbound into their country under different visas. But now you have this opportunity in the UK, at least I think temporarily, where you can maybe hit the UK temporarily under some of these proposed changes, have a really good tax setup, and I'll let you talk about that. And then you can think about, do I skedaddle to somewhere else? Do I then go into the UK tax regime, whatever that may look like? But those are the kind of things that are on a lot of people's minds right now. So what are your thoughts on this?
Yeah, so to talk through, I guess, more specifically what some of the proposed changes are, essentially what the UK is looking to enact is, again, based on a residency standpoint. They will allow individuals who become UK tax resident but haven't been UK tax resident for the prior 10 years to that. The first 4 tax years that you spend in the UK, you will be allowed to receive basically full tax exemption, full tax relief on all foreign income and gains that are earned in those first 4 tax years that you're present in the UK. Now, under the current system, you have the opportunity to be taxed on that kind of remittance basis. And so, if you have foreign income and gains, you're not automatically taxed on that in the UK, but you would be taxed on that if you later remit that to the UK. And the difference here will be that all foreign income and gains for the first 4 tax years will be 100% tax exempt from a UK perspective. So whether you leave that untaxed income offshore and 10 years later want to bring it into the UK, or you want to just bring it into the UK straight away, you would be allowed to bring that into the UK at present and in the future without paying any additional UK tax. So for a US person, as an example, they would still be paying US tax on their income because they are taxed on a worldwide basis, but then they don't have to worry about the timing of the taxation between the US and the UK in those first four tax years. They have more flexibility and freedom in terms of how that income ends up getting used. Following the first 4 tax years that somebody is resident in the UK, then after those 4 years, you would automatically move on to the arising basis of taxation. So you would pay tax on a worldwide basis in the UK, and in the example that it is a US citizen as well, then they'd be taxed on their worldwide income in the UK and the US, and you then manage foreign tax credits between the 2 jurisdictions. The other piece to the changes are that essentially the proposals say that from an inheritance tax perspective, inheritance tax would also be based on a residency standpoint. And after 10 years of residency, you would be subject to worldwide or exposed to worldwide inheritance tax in the UK. after being resident in the UK for 10 years. So that previous 15 out of 20 year window would be reduced to 10 years. But interestingly, because that whole tax system is moving to a residence-based tax system, and domicile no longer matters, things like formerly domiciled residents returning to the UK, so UK nationals maybe who moved to the US for a period of time and are now looking to return to the UK, they also now will have the opportunity to take advantage of these new residency-based tax rules. Whereas under the current regime, they would be considered domicile pretty much from day one and would have to pay tax on a worldwide basis from day one. So there's a very interesting kind of opportunity for returning domiciliary UK nationals to the UK, where they're going to now have more favorable tax treatment than they used to.
Yeah, that's huge. And at the Wolf Group, we serve a lot of G4 visa holders, World Bank, IMF, those folks. There's a great opportunity, I think, for those individuals, because my understanding is those pensions are not taxable in the UK. I think there's a court case that highlights that. But if you go from that G4 visa inbound into the UK, even if you're formerly from the UK, and you're now in these new non-dom rules, that could set up a little bit of a sweet spot for you. So that's the first thing that kind of jumps out at my mind. Also, what you talked about with the foreign tax credits, and I want to ask you a question about that here in a second. But sometimes we have to do a little bit of re-engineering on the tax return for the foreign tax credits, where you have to go into an accrual basis, or you have to resource under the treaty, things like that. That gets a little sticky and complicated. I'm not the biggest fan of doing that. But just for the folks listening to the podcast today, I think most people should be familiar with the U.S. tax code and the tax rates, up to 37% in the U.S. That's progressive system of tax. What are the tax bands in the UK currently, and do you have any feeling of if they'll go up or down or stay the same?
Yeah. So currently in the UK, there's three main tax bands that exist. Essentially, if you earn up to £50,270, so roughly £50,000, you pay tax under a basic rate band, which for income tax is 20%. And then the next between 50,270 and 125,000, I think it's 125,540 pounds, you would be a higher rate taxpayer and pay tax at 40%. And then anything above that would be taxed under the additional rate band, which is 45%. So the top rate of tax for income tax purposes is 45% versus the top rate of income tax in the US being 37%. And then equally from a dividend rate standpoint, because this is the other area where there is a fairly big difference under current rules, the dividend tax rate for basic rate taxpayers is 8.75%. So that's lower. But anybody who is an additional or a higher rate taxpayer, that tax rate is 33.5%. And then for somebody who is a additional rate taxpayer, that tax rate is 39.35%. So you're looking at a much higher kind of tax rate for dividends versus kind of the US more favorable top rate of 20% if it was a qualified dividend.
Is there any special capital gains tax rates, or how does capital gains work in the UK?
Yeah, so capital gains taxes currently in the basic rate band would be taxed at 10%, and then higher rate and additional rate taxpayers pay capital gains tax at 20%. So that is a similar rate to the US. In terms of potential changes that may happen, there is a bit of an unknown from the standpoint that the first Labour budget is scheduled to take place on the 30th of October. And that's when we will get full visibility in terms of kind of the full kind of tax changes that they may be enacting on a go-forward basis. However, if we can rely on kind of specific claims that the party has made in their manifesto and subsequent speeches, they have basically stated that they do not intend to make changes to income tax rates, and equally they haven't really been focused on any change from a dividend tax rate either. What they have been very, very silent on has been capital gains tax. And they have advocated the desire to want to align capital gains tax rates with income tax rates. And so, that would result in, a current 20% rate, going up to 45%, if somebody was an additional rate taxpayer, which obviously is a very drastic difference. And, do we think that they're actually going to kind of go in fully in that direction? I don't know. I'm a bit skeptical, to be honest, because I do think they're also very conscious of the fact that they need underlying economic growth and investment to help underpin some of the additional spending that they're looking to take forward. And so, I do generally think if they did go ahead and align it with, income tax rates, that people just won't sell anything, and it will kind of, not actually raise any revenue much at all. Whereas I think it would be very easy for them to return to a 28% tax rate, which was in place not too long ago, or even maybe a 30% rate or something similar. But again, until we know, we won't know until the end of October exactly what they will do. But that does raise the the question, earlier you did say, from a planning perspective, that most people will have, until the 6th of April, 2025 to kind of do full planning for these non-dom changes. But when it comes to kind of the capital gains tax side of the equation in reviewing people's situations, it is definitely probably prudent for certain individuals to be reviewing their capital gains tax positions from an unrealized standpoint ahead of the 30th of October. Because if the Labour government does choose to increase capital gains tax rates, they could choose to do that from the 6th of April 2025 in the new tax year, or they could also make that proposal take effect from the date of the budget statement, which is not entirely out of kind of historic.
And so to be clear, that budget proposal, October 30th is that date that it comes out on. So like in the US, like the Tax Cuts and Jobs Act, it's like November 2nd was the date, and that like nothing could change after that. So, okay. So October 30th, everyone's got to circle that with a big red pen. And that's kind of going to be a interesting date to see what they put out there. Now, when we talked prior to the show, you were throwing out concepts to me, which I've always thought are super interesting, related to capital gains. And I think you kind of touched on this just now, but you were using terms like rebalancing, clean capital, things like that. Can you just walk at a high level through what those terms mean and kind of maybe go a little bit more in depth about the capital gains planning that may be applicable?
Yeah, so, with respect to somebody who is UK resident and, for instance, also a US taxpayer, anytime they sell any investment securities, so if they're reviewing a portfolio of assets and looking at what they should buy and what they should sell, and that's generally the concept of rebalancing a portfolio. Every time that somebody sells a security, you not only have to look at that sale from a USD standpoint, say it's a US portfolio that is denominated in US dollars, you not only have to pay attention to that USD unrealized gain that you are now realizing, you also have to consider it from a UK GBP standpoint. And so And in order to do that, you have to look at the GBP value of the security on the date of purchase and compare that against the GBP value of the security on the date of sale. And so any FX movement that has happened between the US dollar and sterling will also factor into the total gain that you actually realize from a tax standpoint here in the UK. And sometimes FX movement can work in your favor, and sometimes it very much can work in your favor.
Yeah.
And so, for instance, pretty much what we've seen since Brexit in 2016 is that we have generally had a weaker sterling relative to the dollar. And so for people who own securities for a longer period of time may have a lot larger embedded sterling gains in their portfolios than what it on face value looks like from a dollar standpoint. And so it's very important to review the portfolio from both a sterling and dollar perspective where somebody is tax resident here in the UK. And I think where that becomes even more of a consideration under these new rules is the standpoint where somebody might currently be under the remittance basis of taxation from a UK standpoint, and so their US portfolio isn't really being fully looked at from a UK tax perspective because their US dollar income isn't actually being taxed in the UK. But if they'll find themselves in a position where they've been resident in the UK for more than four tax years after the 6th of April 2025, but still less than, they're still currently less than meeting the deemed domicile rules here in the UK, then all of a sudden, those people may be in a position for the first time having to kind of really think about their sterling gains and how much that may cost them from a tax perspective. And for those people, those are that's where the planning becomes very, very valuable ahead of either the end of October or the beginning of April to assess whether any investment changes should be made ahead of the time that they're going to be paying tax in the UK on a worldwide basis.
Okay, and so that meets out of the four groups of people that I identified, that basically talks to one or two of those groups. What are you saying anything or thinking of anything for planning for those other groups of people, the already deemed domicile folks or people that are maybe coming inbound for the first time, that are thinking about coming inbound? Do you have any thoughts about what you would be telling them or saying for them to think about or do?
Yeah, I think we can probably touch on a couple of the groups in terms of what they should be thinking about. I think for the people who haven't yet arrived in the UK at all yet, the new proposals actually provide a very unique opportunity from the standpoint that they will have that 4 year, provided they hadn't been UK tax resident for a prior 10 years, they will have those 4 years where they could, in theory, go about restructuring and making changes or have some sort of transaction take place. And from a UK perspective, there will be no tax that needs to be considered on that at all. And so, for instance, from a restructuring standpoint, what we often find with US people moving to the UK is, if they have an existing US portfolio in place, they may have that portfolio full of loads of US mutual funds or US ETFs. If those mutual funds or ETFs, fund type investments, don't also have something called reporting status from a UK standpoint, and there's a big list on the HMRC website which outlines what funds qualify for reporting status, but many US funds don't. If they don't fall into that bucket, then those securities, when sold from a UK perspective, would actually be taxed at something called offshore income gains rates as opposed to capital gains rates. And what that means is actually that GBP gain would be taxed at income tax rates as opposed to capital gains tax rates. So again, for an additional rate taxpayer, it could be taxed at 45% instead of 20%. And so with this new window, it allows kind of the changes in an investment portfolio to take place, to kind of restructure into something that is tax efficient for a UK perspective, happen during a window where they don't have to then think about UK tax at all. And there's probably also a subset of people, obviously US citizens will continue to be exposed to the US tax, for any changes that they make, even if they're living abroad. But there could be a scenario, for instance, where, say, a G4 visa holder moves to the UK. They're no longer exposed at all from a US kind of tax perspective, even though they were kind of only exposed on a limited basis. But they could then move to the UK in those 4 years and potentially sell assets that they have, and not have any US tax to pay on that, and equally not have any UK tax to pay on that. And so that 4-year window for those people moving here just provides a lot of flexibility to kind of, either have a certain transaction take place during that period of time, or just kind of generally restructure on a go-forward basis. Equally, for people who maybe are already here, but have only been here maybe for a year or 2 years, as they kind of cross over the 6th of April 2025, if the 25-26 tax year still falls within their first 4 tax years from a UK perspective, then they will also have, albeit a shorter opportunity, but they will still have some, time period, whether that's 1 tax year or 2 tax years or 3 tax years, to essentially have a transaction take place or restructure their assets without there being any sort of UK tax implications that need to be considered on that.
So shorter runway for those folks, potentially, depending on where they're at in their timeline.
Yeah, exactly. And equally in that scenario as well, you could have, for instance, a current individual who is UK domiciled. So, that formerly domiciled resident who has returned to the UK in the last year or two. And, since returning, they currently are having to pay tax in the UK on a worldwide basis. But then, come 6th of April, 2025, they could, if they are still within that 4-year tax year window, they could also have, a scenario where actually for a couple of years, they're reverting back to kind of that tax exempt system for foreign income and gains, and then thereafter pay tax again on a worldwide basis. So and that's kind of a unanticipated benefit, really.
That's very cool. And HMRC has the ability to track all of this. You think that they will know if you
It's an election, basically. So you would still, have to file a return, and you would kind of be disclosing and, what they call a white space note, kind of what the situation is. So yeah.
Yeah, and just for the folks at home, HMRC is the UK version of the Internal Revenue Service. Hopefully I'm making the right equivocation there.
Yep.
Okay, do we think that, my observation is that UK tax return preparation, unlike the US, is pretty straightforward, unless you have, I guess, a super complicated situation. Do you see that staying the same? Do you see that changing? If you're Nostradamus and you're looking in your crystal ball, and I'm trying to do my fiscal year 26-27 return, is it easier, same, harder?
I think in some ways it becomes a bit easier, right? Because you don't really, it's just a bit more straightforward in terms of how things are being treated. That being said, there will be certain disclosures that you need to be made, depending on somebody's situation, and also you have to be able to manage kind of the foreign tax credits application properly. For somebody who has a mix of they've been here for a little while, and maybe they still have untaxed income, offshore from a UK perspective. There are still going to be kind of remittance considerations there. So like for those people who have already lived through kind of paying tax on the remittance basis, and later want to bring money into the UK, there isn't kind of a real get out of jail free card for those people. Their situation won't be quite as simple as somebody who's newly arriving in the UK and never has to kind of worry about untaxed offshore income. So there definitely are scenarios where it's probably not so straightforward to kind of do it yourself, but in general, it's not getting any more difficult than how it currently is. But I think it's worth mentioning as well for those people who are falling between, say they've already been in the UK for 4 years or more, or by the time April 6, 2025 comes around, they'll be past their 4th tax year, but they're not yet deemed domicile in the UK. The government has said that there are a few transitional arrangements that they are preparing to put on offer to help make the fact that they will now be subject to tax on a worldwide basis, a bit more palatable. And the two kind of proposed transitional arrangements have to do with a potential opportunity to rebase existing offshore assets, and also a window of opportunity to remit prior untaxed income into the UK at a reduced flat tax rate. So just to speak more specifically about the rebasing opportunity, essentially what that opportunity will allow is that any assets that are still owned after the 6th of April 2025, when a prior non-dom individual goes to sell those assets, they would be able to look at basically the unrealized gain or loss on that security from the date of rebasing valuation to the date of sale. And if that is more favorable than looking back to the original purchase date of that security, then you're allowed to essentially make that election on a security by security basis.
Oh.
Now, in the original proposals, that rebasing date that was going to be on offer was, for some reason, nobody knows exactly where this date came from, but it was the 5th of April 2019 that was essentially going to be used as the rebasing date. Labour has come out and said that we will offer a rebasing opportunity, but we are currently considering what date makes the most sense. And they will announce that deemed appropriate date on the 30th of October at the budget statement. I think there's a lot of speculation that thinks that that new date is going to be closer to the 6th of April 2025 than the 2019 date. But it could fall anywhere in between. I think everybody's in consensus that it won't be a date earlier than 2019.
So there's some transition. These are transition rules you're basically talking about that where there's
Correct.
additional planning that could happen. Sorry, I didn't mean to cut
Correct.
you off. Was there something else that you wanted to add?
Yeah. Well, I was just going to mention the other transitional arrangement essentially that will be available is for those individuals, again, that have prior untaxed income from a period of time that they were paying tax in the UK on a remittance basis. They are offering a window where the original proposals were offering a 2 tax year window for this. Labour has indicated that that window may actually be longer, but again, that won't be announced until the budget statement at the end of October. But basically, for any kind of untaxed offshore income that somebody wants to now bring into the UK and be able to use in the UK, they will tax it at a lower flat tax rate if you remit during that window. And then if, for instance, you do it at a later date after that window of opportunity expires, then you'd pay tax on that at normal tax rates. The original proposals outlined a 12% flat tax rate for that transitional arrangement. Labor has basically indicated that they're exploring kind of what rate makes the most sense. So again, that kind of indicates maybe that rate will end up being a bit higher, but it should fall somewhere between actual rates and and that 12% rate. So for people who need to generate more clean capital in the UK, and I know actually you kind of asked for a definition of clean capital a little while ago, but I didn't quite get there. Clean capital is essentially money, cash assets that you can bring onshore into the UK without any additional tax charge. So, for instance, going back to that example where I was talking about having a bank account with cash and some interest income, if you have a bank account with $100,000 in it and there's $5,000 of interest in that account, then anything past the $5,000 of interest that you bring into the UK would be considered clean capital because it wouldn't attract an additional tax charge in the UK.
Very cool. Okay, so I just want to make sure we've talked about all the stuff that is in the proposals before we move on to the protected trust regime. I wanted to hit on that before we kind of got to the end here. Is there anything else, though, that you think needs to be brought up related to the proposals before we get into that?
Before moving on to the protected trust regime, I think one thing to kind of note with respect to deemed domicile individuals or individuals who are already deemed domicile with those transitional arrangements, I guess deemed domicile individuals would already be in a position where they're paying tax on a worldwide basis here in the UK. So, they're not kind of going to be surprised in a way in terms of how their tax treatment changes from a income tax and capital gains tax standpoint going forward. The rebasing opportunity in the transitional arrangement is not expected to be available for deemed domicile individuals. But the temporary remittance facility, so kind of the ability to bring prior untaxed income onshore into the UK at a reduced rate, is expected to be on offer for deemed domicile individuals. So, if you were a deemed domicile person who still has a bunch of kind of untaxed money, mixed capital offshore, and maybe they're in a position where their clean capital that is available to them in the UK is dwindling, and they'd like the opportunity to kind of enhance that sum, then deemed domicile individuals would be able to take advantage of kind of that reduced rate of tax to remit untaxed income for whatever window ends up being available.
Okay, so a little bit of an opportunity for them, not as beneficial as some of the other folks, other groups that we talked about. Okay, moving on to the protected trust regime, because I think there's a lot of movement here. My viewpoint is that the United Kingdom has very specific viewpoints on a lot of U.S. trusts, i.e., the UK doesn't like our trusts. That's as simple as I can put it. Can you tell me a little bit about the protected trust regime and kind of the proposals around that, and if there's some synergies perhaps between the U.S. UK on trust planning? And remember, try to talk to me like I'm a 3-year-old, because trust stuff is super complex, and I can see a lot of people's eyes just kind of glazing over when we start talking about trust. So,
yeah. Well, one thing I'll say is I do think to some extent it goes both ways. The US doesn't really like foreign trusts.
We don't like any foreign trusts.
And the UK doesn't really like foreign trusts from their perspective as well. And obviously US trusts fall into that umbrella. But specifically for non-domiciled individuals, there has historically been an opportunity to essentially settle what is called an excluded property trust from a UK standpoint prior to the point of becoming deemed domicile in the UK. So historically, it has been a very popular planning point that ahead of meeting that 15 out of 20-year test of being considered a deemed domicile individual in the UK, if you were wealthy enough to kind of be able to shelter assets in a trust, an individual would settle a trust. Usually, if it was a US person, they'd settle a US trust and essentially put assets in there that, as long as they were non-UK situs assets, would be fully protected or considered excluded property from a UK inheritance tax standpoint. Now, that was really valuable, and has been very, very valuable because of the fact that the UK inheritance tax allowances available are much, much smaller than what is available from a US standpoint. So to give you an idea, basically each individual in the UK that is subject to inheritance tax is offered a what's called a nil rate band of £325,000. And between two kind of UK spouses, you each get £325,000. And then if your total estate was kind of £2 million or less, then you also can receive each an extra £175,000, what's called a residence nil rate band allowance, so that a couple could have up to £1 million of kind of estate tax exemption in the UK before estate tax is actually applicable.
Oh, okay.
And so, but if, for instance, somebody's estate was worth more than £2 million, then that couple would have £650,000 allowance versus that £1 million allowance, because those residence nil rate bands are essentially tapered down as your asset, your net estate grows. So, so excluded property trusts for non-domiciled individuals was kind of the really kind of important estate planning consideration ahead of becoming deemed domiciled, because somebody could settle a trust from a UK perspective, shelter that for inheritance tax purposes. But on the US side, they could decide that they wanted it to be a completed gift from a US perspective, or they could decide, I don't actually want to fully give away that money from a US perspective. I purely want to protect it from a UK inheritance tax standpoint. I might later return to the US, and then I might want to actually just disband that trust and do something else with the money, because I don't think I'll have US estate tax issues. So there was flexibility around how somebody could go about settling that trust to protect it from an inheritance tax standpoint. Alongside the protection on the inheritance tax side of things, the UK also had these rules around, from an income tax and capital gains tax standpoint, how these sorts of trusts were actually taxed in the UK. And if the trust was considered to be settlor interested, which essentially means that the settlor is a UK resident, and either they retain an interest in the trust, their spouse retains an interest in the trust, or their children retains an interest in the trust, then they would fall under something called the protected trust rules from an income and capital gains tax standpoint, which essentially meant that in the UK, you would not pay tax on interest and capital gains and dividends as it arose inside the trust. You would only pay tax in the UK as a UK resident beneficiary actually benefited from the trust. And so with the protected kind of tax regime on trusts from a UK perspective, that trust essentially operated under the remittance basis from a UK standpoint, that as the income arose, it would be protected from tax, and you would only pay tax as you actually received a benefit from that trust on a go-forward basis. That caused some issues from a US and UK perspective if the individual was a US person, because from a US standpoint, generally they're going to pay tax on those trust assets on income as it arises. And from a UK perspective, you wouldn't have that matching timing of tax, and so that did sometimes result in a mismatch of taxation between the two jurisdictions and making it difficult to, for instance, get foreign tax credits. Under the proposed changes, basically protected trusts would no longer be protected from an income and capital gains tax standpoint. And so settlers that lived in the UK and have income and gains arising within this type of settler interested trust would become subject to tax in the UK on the arising income and gains annually if they've been in the UK for more than 4 tax years. So essentially, in the same way that individual or personally owned assets would be subject to tax on an arising basis in the UK, a settler interested trust would also be taxable to the settler in the UK as income and gains arise if they've been in the UK for more than 4 tax years. And so for those deemed domiciled people who previously set up excluded property trusts, or for people who aren't yet deemed domiciled but have excluded property trusts in place already, that does represent a very real change to what they've experienced to date.
Okay, great. So we're getting here towards the end of the show, and that was very insightful on the protected trust regime. I want to do a quick hits, 5 quick questions, and basically it's yes or no on what you think is going to happen. And so let's get started. Will there be an increase in the UK individual income tax bands? Yes or no?
No.
Will there be an increase in the UK corporate tax?
No.
Will there be a UK wealth tax?
I'll say no.
Okay. Will there be a UK tax for green energy or reduced carbon emissions, or because Labour Party's real green, right? That's my understanding. Any taxes coming out of that?
I haven't heard anything about that.
You haven't heard anything about that? No, of course not.
Yeah.
Okay. Will there be, now this is a really interesting one because there were some reports that just came out about the fact that ever since Panama Papers and whatever the one that was after that came out about a lot of UK people having offshore assets and UK tax evasion, avoidance, whatever you want to call it. There's really not been one single prosecution by HMRC or one person that's been identified or put under the coals. Will there be an enhanced scrutiny on UK tax evasion avoidance? Yes or no?
Yes. Yeah.
Yes. Okay. So
I think that has already started.
There's
loads of kind of inquiries and things like that, out there, and I think that will just continue.
Okay. And so, there's a whole host of other things that we could probably go on and on and on about. I mean, I want to do a segment about will there be a new US UK tax treaty? There's going to be a model. The US is going to be putting out a model 2026 treaty, which in my head, I'm like, okay, well, if you've got April 6th, 2025, with this new UK laws, you've got the Tax Cuts and Jobs Act sunsetting, probably a new US tax code, Jan 1, 2026, a new model treaty. Will there be a new US treaty? There was comments about the net investment income tax, whether that'll get a foreign tax credit available to it or not, which would be huge between the US, UK. There's all sorts of things that I think I want to follow up with you on. In addition to this, obviously October 30th, we're circling it on our calendar. Will you come back and talk to us once we have all this good stuff from them put out there, the draft legislation, and kind of give us some more guidance? We're going to be looking at this. In the United States, I always joke Halloween is like 10 days long because there's a different Halloween. My 8-year-old, my 4-year-old, I feel like I've got to go to a million different parties between like October 25th and October 31st. So I'll be doing the same thing where I'm kind of checking to see when it drops and at a Halloween party. But after we get into, say, November, December, when would be a good time, to kind of check back and see, what's going on? Is there like a calendar of planning that people should consider or think about?
I mean, I generally think that kind of as soon after the 30th of October kind of rolls around, people will need to kind of, get moving with respect to kind of planning for the end of the UK tax year, because it will be a very short window. And in general, I would recommend people starting to think about their personal situations ahead of the 30th of October, just to think through some different scenarios and how they might react to it. Because again, it is a short window. I think professionals will be very, very busy, between that. And there very well could be things that individuals, for US, UK people, things that individuals want to do ahead of the 31st of December, as opposed to the end of March or beginning of April of next year. So I personally think kind of as soon after the 30th of October happens, I think that will give us the detail that people need in order to actually then kind of put their head down and take some actions.
Okay. And you have some materials for us that we're going to link to the show notes. We're going to link all of Andrea's details and put all the stuff, all the moving parts that we can, the announcement, the whole ball of wax. It'll all be in there. Andrea Solana, thank you so much for being on the podcast today. We really enjoyed having you.
Thank you. It's my pleasure.
You've been tuning in to the Essential Tax Podcast with your host, Mishkin Santa. You can find this show on all the major platforms, including YouTube, LinkedIn, Apple Podcast, Spotify, and on our website, thewolfgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.